Part of what you're going to need to do in order to win at tax strategy is know which things are worth your time and which things are not worth your time. And I promise you, the internet is chock full of shiny ideas that are not worth your time. And so I'm going to give you a concept here that's going to help you distinguish things that are worthwhile from things that maybe aren't so worthwhile. MicroStrategy and macro strategy. MicroStrategy is little things. Now, in the context of tax, a MicroStrategy is something that maybe gives you a small tax savings, a couple $100, maybe $1,000. And things that are MicroStrategies include some of the most popular buzzwords on the internet. The Augusta rule, for example. Big time MicroStrategy there. It's not that it's bad. And when I'm talking about MicroStrategies are not necessarily bad strategies. The problem is they can distract you from much more meaningful macro strategies. Now, a macro strategy is a more large-scale strategy, and typically I define it with the following characteristics. It's something that's useful year after year, has a substantial tax savings, and generally you're going to set it up once and be able to leverage it for years to come. Now, leveraging an S corporation, that could be a macro strategy. An S corporation that's well done typically saves the taxpayer anywhere from $15,000 to $20,000. So that'd be considered a macro strategy. You're talking about a 5-digit tax savings instead of a 3 or 4-digit tax savings. Now, there's a little bit more work involved, and the strategy usually has some maintenance as well. So a macro strategy, like say again, utilizing an S corporation, that's going to have some maintenance. You're going to have payroll to pay for. You're going to have an extra tax return. You have to do a corporate tax return for the S corporation. But in exchange, you're going to get a substantial enough savings that it's going to make the strategy worthwhile to use. And that's why we consider that to be a macro strategy. Another macro strategy that is really not used very often but can be very powerful is something called the qualified small business stock strategy. Basically, it's a strategy where you can have shares of a small business C corporation that when you sell them that can be excluded from capital gains tax. And when you're talking about something of that substantial size, you're going to have a lot of setup involved, there's going to be a lot of maintenance involved while you're running it, but in the long run, the tax savings is very, very substantial. But let's go apples to apples for a second. We're going to compare our S-Corp strategy to our Augusta strategy. Now, in the Augusta strategy, we actually had a ruling from the tax courts just last year about. A lot of people have been overusing the strategy and really trying to milk that cow for all of its worth. The problem is, the IRS didn't quite agree with some of the numbers people were using on that Augusta strategy, and the tax court ultimately sided with the IRS on this. So last year, someone had a ruling that said they could only take $500 per rental for the Augusta strategy. Now with Augusta, rent your home to your corporation, let's say 4 times a year. You only might be able to deduct $500 per occurrence. That's a $2,000 deduction. Okay, so I got $2,000 out of that. Well, hold on now. I said you got a $2,000 deduction. Here's the way we calculate the value of that. The $2,000 deduction is only worth whatever your tax rate is. So let's say your effective tax rate is, just for the sake of a number, 20%. Well, 20% of $2,000 is $400. So your actual tax savings in that, you're only making a couple $100 out of that. Meanwhile, to leverage the Augusta strategy, you need to have a lease, you need to have paperwork, you have to be able to prove beyond a reasonable doubt that you legitimately use this strategy. All the work you're going to put into that might not even be worth it in the end if you're only getting a couple $100. Whereas in S election, okay, calculate our reasonable salary, we've made our S election, we've put ourselves on payroll. Well, now we're reducing our FICA burden by $15,000 a year. Remember, I didn't say a $15,000 deduction, I said you reduced your FICA burden, your Social Security and Medicare tax, by $15,000. Okay, great. Well, $15,000 sounds a heck of a lot better than $400. And while we're on the subject, I'll go ahead and talk about a MicroStrategy that every salesperson pretending to be a tax person loves to talk about. Every single year during the summer, I start getting marketing emails, I get things sent to me, reels, people talking about write off your 4th of July barbecue. I actually sat down last year and calculated the value of it. Now, aside from the fact that it's very hard to push that as a business deduction, I'm not saying you can't do it, I'm saying it's hard to make that argument. To the point, it would take a ton of work. Okay, so let's be generous. Let's say you spent $2,000 on your 4th of July barbecue. You bought just piles and piles of meat for the smoker, right? We can only deduct the portion that is business related. Let's say that we can make the argument for 50% business deduction on that. Okay, great. We got a $1,000 deduction. The amount of paperwork and documentation that you're going to have to create to prove that was a valid deduction and not just you trying to cheat the system is so extensive that even in this example, we're only getting a $1,000 deduction out of it. Now remember, the value of that deduction is relative to your tax rate. So if we take that 20% again, heck, let's be generous, let's call it 40%, higher than the top tax bracket currently for the federal tax rates. 40% deduction on $1,000, again, we're coming out to $400. So you're gonna do all this work, all this effort to orchestrate a business-related 4th of July barbecue, all this paperwork and all these receipts for $400. Now, here's the real problem with the micro strategies is they distract you from the macro strategies. You're gonna get ooh-shinied into Augusta, you're gonna get ooh-shinied into writing off your 4th of July barbecue. You're gonna miss an opportunity to leverage an effective, efficient S corporation or an effective, efficient C corporation. Something that's more of a macro strategy, a structural level strategy that has a meaningful difference, not just for this year, but for every year after with just a bit of modest maintenance. Now, when we do tax planning with clients, we like to focus on the macro first and then the micro second. I get clients all the time. We first start working with them. We're a few weeks in. Hey, Dan, when can I start using Augusta? Hey, Dan, when can I hire my kids? Hey, Dan, when can I use an accountable plan? Well, we will get to that. But what I don't want you to do is I don't want you to get so ooh-shiny by all these little micro strategies that maybe are collectively worth a couple $1,000s in your case, depending on the case, when you could have a good macro strategy make you so much more tax savings that year. You want to start from the top and work your way down. Start with the most effective tax strategies, the greatest macro strategies that you can legally use, and then work your way down to the least worthy micro strategy. And all along the way, ask yourself, is the work involved for this micro strategy even worth the return on investment? Is the juice worth the squeeze? That's all I got for you today. Make sure you check out our other videos here on RLT, and make sure you check out reallifetrading.com if you ever want to learn how to trade stocks. I'll see you in the next video.